Hey everyone, welcome to the KE Report in a daily editorial. We are chatting with Dave Erfle, founder and editor of the Junior Miner Junky, and we're going to be talking about the big news out of the gold sector. It is the takeover business combination, however we want to term it, with Equinox Gold and Calibre Mining, the two fairly decently sized producers coming together to arguably form a new major company. The implied market cap of this combined company will be little under $8 billion Canadian. This is a transaction where there is no premium for, I guess, the Calibre shareholders, as they will be taking, I believe, about 35% of this company as long as all the votes go through. This will create potentially right around 1 million ounce a year producer. So again, this is a scaling up of these companies, but look, there's a lot of chatter going on out there of people just not excited about this deal. Equinox, a high cost producer. Calibre was doing very well, share price wise, and with some growth on the horizon. In all fairness, Equinox also has some growth on the horizon. So Dave, let's start off. Your overall take from this, I guess, combination, business combination or acquisition, as we could call it.
Yeah, Corey. If I was a Calibre shareholder, I wouldn't be very happy. I mean, it's billed as a merger of equals, but it's not a merger of equals. I mean, when one shareholder base is going to own 65% of the company and the other shareholder base is going to own 35% of the company, it's a takeover. So it's a takeover without a premium. And if you're Calibre, your cost basically just went up. Sure, your production went up and your cash flow went up, but your cost just went up. And also, it's combined, they're going to have $1 billion in debt, and the market cap's going to be around 5 billion US. So yeah, as far as another, if you're a Calibre shareholder and you're thinking, okay, I don't like this deal, but maybe another major is going to come along or and make me a better offer. I don't see that happening either because the termination fees are extremely high. The break fee for Equinox is 145 million and Calibre is 85 million. So I don't see that happening. But as far as if the deal goes through or not, then you're thinking, okay, well, maybe it'll get voted down. Well, there is a possibility of that because Calibre has about 60% retail float and they need a two-thirds favorable decision for the deal to go through. But on the other hand, if you're a Equinox shareholder, you like the deal because your cost just went down, your production just went up, your cash flow just went up, and also you're going to be the second largest Canadian producer. You want to be producing gold in Canada right now because you're paying those workers in depreciating currency, and then you're turning around and selling the gold in US dollars.
Yeah, Dave, I'm conflicted as I should probably announce I'm a shareholder of both Equinox and Calibre, but I personally didn't want to see this deal because I wanted to see Greenstone and Equinox have a full year of production and they're optimizing some of their other mines and doing some expansion. I wanted to see that run on its own. And I wanted to see Calibre actually get into production at Valentine after taking over Marathon and let it rip for, the next year and a half and see how it goes. Do you think this is going to truncate the potential re-rating in both stocks by forming such a large company?
I think eventually it will be a good deal if the gold price, continues to go higher goes above 3,000 and stays there, then it will definitely be a good deal in the long run. But in the short run, I think it's going to get bogged down. The share price might get bogged down, especially if the gold price keeps running. So, if you're a long-term investor, then okay, you're not too upset. But, if, like I said, if I was a Calibre shareholder, I wouldn't be very happy and I would be voting this deal down.
So, Dave, look, this is, I think, a trend that we're seeing in the sector where companies are teaming up to become larger. And I think we're going to see it even more when it comes to these large producers or just even mid tier producers. One thing I've been saying, though, is that this sector needs more growth, even if it comes at higher cost of production. If you, let's say, raise your cost by 20%, but you can produce double the amount of gold at these higher prices, that makes sense. But again, that's at these higher prices. So does it make sense just simply from that aspect that even though costs are going to rise on Calibre's side of things, at least it'll be part of a much larger company that is producing a lot more gold.
Yes, it does, and it's creating another major, and it also happened on the very first day of the BMO conference. So, that conference is starting to buzz. So that's what these guys are getting together and talking about right now. First at BMO, and then they're going over to PDAC. They're talking mergers, acquisitions, getting bigger, adding more ounces any way they can. And this is good for the sector.
Well, Dave, let's also dive into some of the nitty gritty on as far as the different jurisdictions that are mashed together here. Some people in one company may not like the jurisdictions the other. They're both in high risk jurisdictions and Canada and even the US with Calibre with a small portion. But you got this safer Canada larger mine portion, and then you have this riskier peripheral set of secondary mines. Do you think some of those will get divested out of this company? Would that be an opportunity for other juniors to pounce on those? Are we going to see that trend if we see more M&A deals between mid-tiers where, yeah, they come together, but they probably aren't going to keep all the mines?
Yes, I believe so. That's what Newmont just did, and I wouldn't be surprised if this deal goes through that the new Equinox will probably divest the Nicaragua asset. That's the red flag, sore thumb, highest risk jurisdiction in the portfolio.
So, Dave, how do you analyze this company then? Because look, costs are going to be higher, but there some mines that are coming online here from each asset. And yes, there is debt that's coming into this company, but quite frankly, it very well could be a 1 million ounce producer here in the very near term. So I know the argument has been that there's a re-rate here simply because the price to NAV pro forma looking like it's under 0.5, where senior producers around 0.6, American focused seniors around 0.8. Do you see that re-rate potential?
Yeah, I mean the combined companies, I think it's going to have a market cap of close to 5 billion, and the enterprise value is close to 6 billion. So yeah, I mean there is re-rate potential, but there's re-rate potential, for the whole sector. But the risk here basically is that debt. That 1 billion in debt. I know Ross Beatty was saying they were talking about working off the debt, and now they announced this deal which will add more debt. The debt is the problem, but as far as the re-rate potential, that's definitely there because the enterprise value is still 1 billion higher than the market cap.
Well, Dave, I did listen to that interview with Ross Beatty. One of the points he makes in it with Paul Harris is that they're going to bring in what he called a flood of new institutional investors that wouldn't touch them when they were a smaller
Mm.
company, but will now that they're over a certain size. And I also want to weave into this discussion something we've talked about a million times, but Equinox has the big board listing on in Canada and the U.S., and I think that's so important where Calibre didn't. So maybe speak to could that be an advantage to attract a different class of generalist investor?
Absolutely. That was going to be another point that I was going to bring up. Calibre didn't have that big board listing, but Equinox does. That is huge.
But is it that hard to get a big board listing? The way that Caliber was growing, you would think that could have been part of their plan in the next year or two.
Right. Yeah, it's not hard. It's just expensive, and a company like Calibre, they can afford it.
But what about bringing in the bigger institutional investors because they hit a certain critical size? Is that something mid-tier should be considering, massing up to attract a different class of
Oh,
investor?
absolutely. I've been pounding the table for a lot of these companies to do that because once their share price gets over, I think it's $4, then funds can invest in them if they have a big board listing.
Hey, open up that US audience. The US market is critical, and that is a selling feature, I'm sure. But look, I'm sure Caliber could have done it themselves. This is, though, another major on the board. Does that help out any other companies in the sector, or does it actually pull money away from some other mid tiers because we do have a new major?
I don't think it pulls money away from any of the other companies, but I just think it attracts more attention to the sector. This is what we need. I mean, I'd love to see another merger of a majors or a major taking over a mid-tier coming out of these conferences to bring more attention to the sector because as we all know, it's deeply undervalued and deeply underowned, especially compared the undervaluation compared to the gold price.
Well, Dave, another message that we keep seeing in these takeovers, whether we think about Gato Silver being taken over by First Majestic or Silvercrest being taken over by Core Mining, and now seeing this transaction where Calibre is being taken over by Equinox, is the big companies are buying production. They're not buying as much development assets. Do you think that's the trend we'll keep seeing, where it's just easier to buy mines already in production?
I think we're going to see both. I still think we're going to see more mergers in the junior space, and I think we're going to see more juniors purchasing a developing mine to have that cash flow to pay for their expenses while they're de-risking their projects, and that's a great model. I think we talked about it last week, where companies that have done that already are really getting rewarded by the market.
Well, but that makes sense, doesn't it? Is the fact of the matter is you want to be in production now. Just because you can take over a development asset that could be in production 2, 3 years down the road, sometimes at best, you don't know what that gold environment's going to be. So you need the cash now. So isn't that probably better for companies? Yes, it's great to have a development asset, but take advantage of the gold price where it's at right now by acquiring production.
Absolutely. You're getting that leverage right away, because obviously, most of these companies, they're not getting that leverage to the gold price. The gold price goes up $1,000 from late October last year, from late October in 2023 to late October 2024. And a lot of these development companies traded sideways or went lower. But if you got that cash flow to basically cover your expenses and help you keep money in the treasury while you're de-risking your development projects, then those companies were rewarded, and they're going to continue to be rewarded.
Yeah, and the handful of deals we have seen, whether it's Heliostar, Integra, Discovery Silver, Magna Mining, even Sierra Madre Gold and Silver buying the La Guitarra mine from First
Mhm.
Majestic, those handful of companies have actually been rewarded. Should more juniors consider becoming producers?
Yes, absolutely. Because we've seen other situations where we've seen mergers of equals in the junior space, like when Moneta and Nighthawk combined. Those are two companies with the same problem. They've got large capex projects. They need access to capital, and they need to fund those projects. Well, now they have two projects with the same problem. But if you have a project that is a large capex project and you're de-risking it, and if you buy a producing asset, then you've got positive cash flow while you're de-risking that asset, and you're being rewarded.
So, Dave, taking into account this deal, and in all fairness, some of the other deals we've seen over the last year and a half now of majors combining, large companies combining, not so much huge premiums for smaller companies being acquired by larger companies, does it change your investment strategy at all?
Not at all. I mean, I still like the companies that look like takeover candidates. And especially, you just mentioned Discovery. I was a Discovery shareholder and recommending the stock to my subscribers. We were fortunate to get into that stock really early, got a triple, and sold one-third of the position to have a risk-free position now. And when they announced that Porcupine deal, it's like, hey, this is fantastic. Now, the share price is not handcuffed by Mexico permitting risk anymore. So if another the company that I'm holding right now is a developer that's de-risking a project that doesn't have any cash flow, and they buy a cash flowing asset, then yes, I'm going to be happy. Of course, it's going to depend on the asset and depend on the terms of the deal. But if the terms of the deal look favorable and the asset's good, then I'm going to be happy about it.
Dave, up until now, it's kind of been a buyer's market where they could pick off a lot of companies on the cheap. And we've noted so many times we've seen take unders versus takeovers. Do you
Yes.
think with the gold price being where it is, I mean, I know it's pulling back a little bit this week, but in general, really high price, do you think it's going to switch to a seller's market where there's going to be competing bids and where the premiums go back to 40%, 50% versus the 20 and 30s? Do you think we'll switch from a buyer's market to a seller's market?
Well, I think that, like you said, I think that'll depend on the share price. I mean, the gold price correcting here is basically expected. We had 8 consecutive weeks of solid gains in the gold price, and the gold closed above its weekly upper Bollinger Band for 4 consecutive weeks. And at the same time, you had the GDX show back-to-back reversal candles after hitting 13-year resistance. So the stocks and silver also not being able to climb above $33 and stay there was telling us that the gold price was about to correct.
Yeah, well, we're going through a bit of a correction now, but look, the price has been doing so well, but we're still seeing a lot of M&A. That is one trend that this market has not slowed down on, and they seem to be these much bigger deals. However, there have been also some smaller deals of people combining. We're still waiting for those bidding wars. And hey, we most likely have a new major on the table. We'll see how aggressive they will be, but it sounds like just like all these majors, they're doing some housekeeping and some house cleaning before maybe entering any more acquisitions. Plus, they still have a couple key development assets that they need to complete. Dave, always great chatting with you, and even more fun when there are some of these key stories to discuss. Please, everyone, let us know your thoughts on this deal. Weigh in on our website or on our YouTube page and let us know what you think of this deal and what else we're maybe missing about what this business combination / acquisition is all about. Again, Dave Erfle, founder and editor of the Junior Miner Junky. Dave, thanks for your insights today.
Thank you, guys. Always a pleasure.